FirstCry is a brand synonymous with childcare, new mothers and baby products in India. Founded in 2010 by Supam Maheshwari, it's become a category leader. And I must say, it's a hit with new mothers. I'm a mother and I can personally vouch for FirstCry. It's one of my go-to apps. But Supam, the question for investors is, when do you turn profitable?
This is a very large industry in the first place. We are addressing $34 billion. India creates 26 million babies a year. And we will be $68 billion of the size of the market by CY28, and with such a large market which is growing at a 20% CAGR, it is bound that we will have a journey of our own. If you look at our India multi-channel, it's actually already profitable. We have been profitable for last 4 years in the adjusted EBITDA basis. Our last year adjusted EBITDA was around close to 8.8% for FY24 for an India multi-channel business.
Let's talk about your gross margins. Your gross margins have ranged between 30 to 35%, which is lower than the direct retailers. Any of the listed retailers, they all have minimum gross margins of 40%. Why is yours lower? And you spoke about improving gross margins.
So we have been, obviously, all these years we have been improving gross margin. If you look at our gross margins for last 2 to 3 years, they've been improving year-on-year basis without having any year that we have not improved our gross margin. And this will be a factor that we will be able to improve our assortment mix, our curation, our investment in brands, our investment in our home brand strategies, which essentially will mean that we will be able to continue to compound our gross margins over a longer period of time. Our journey has just begun, although we may look like 13 years.
So 40% plus gross margins is possible, right?
Look, others have done it. We should be able to do it, but we will get there in our journey as we go along. I can't say for the future, but we will definitely strive to get there. It's not something impossible.
Okay. Let's break up your business into India, which is about 70% of your revenues. You have international presence in UAE and Kingdom of Saudi Arabia. And then you have a house of brands, D2C investments in 21 entities, which you house under Global B's. Now, India revenues in particular. Now, FY24 appear to be a bit of a slower growth for you. Reported revenues have gone up by just 7%. Your EBITDA margins are between 8.5% to 9%. Again, lower than the listed peers. What can you guide on the India business?
So look, we are not at a steady state. We are a new age, ecosystem modeled retail organization today. We believe that we will be able to, continue to grow in India as well as international and as well as in global B's, because some of the other, adjacencies that we have done are very recent, very young. From a profitability standpoint, obviously we have grown meaningfully in India from, as I said, from 5.9 to 6.2 in FY23 and 8.8 in FY25. Yes. If you look at our internet, that's adjusted EBITDA margin. Because that's how you should look at the company, because that's the operating adjusted EBITDA margins, and this will continue, and we are not at a steady state. I can only say,
so what when you compare with listed for the India business?
Other listed players are at a very tall EBITDA margins, and we aim to get there. We are in our growth. We will be investing out of the use of proceeds that we will raise from the public markets. We will invest behind our brand, our technology, our supply chain. Getting more customers, and with that we believe that we will be able to continue to expand our gross margins, our operating leverage, and through our marketing cost and so on and so forth, and essentially driving up the operating. Absolutely.
So what are tall EBITDA margins that you're comparing?
Look, they are in high teens. I mean, the good companies, we always sort of benchmark ourselves to leaders who have done there and have become, So
aspirationally, which is that company?
Well, there are good companies. There are all good companies where...
Name two.
I like in person, companies like Page Industries.
Okay.
Yeah, I mean, that's one company I believe they've done very well in terms of EBITDA margins. Even for that matter, Trent.
UAE and Saudi Arabia, because that is bleeding for you. That's the biggest drag for you at the bottom line. EBITDA losses in the international business was 140 crore in FY24, 120 crore in FY20. How long will it be loss-making? Is there a turnaround plan? What is your turnaround plan?
We started in UAE in October 19 and in Saudi Arabia, in Kingdom of Saudi Arabia in August 22. And we have not even finished 2 years. This month we will finish.
So how long does it take to turn around?
So it will be a couple of years as the journey has been in India.
So India took how long for you to turn around?
Well,
if
India
you want to copy the same playbook.
Well, India would take a little longer because we started from scratch,
okay,
right? And in international markets, it won't take that kind of long time because we took all our strengths at a platter, right? And then actually we have done all, the hard work of building our supply chain, our tech platform,
5 years,
brand.
10 years from now?
No. I don't think that's too long.
It's too long.
It's
not
too
even
long.
5 years. It should turn around before that.
Well, much earlier than that.
Next year?
No, I won't say that. But
okay,
but yeah, we'll get there much faster than what it has taken India. India, it took us almost nine and a half years to get to a operating break-even. I think it should take much less.
You spoke about how you're replicating India's playbook in UAE and Saudi Arabia. But India is a very unorganized retail market for childcare, while GCC is a very organized retail market. So in that sense, it's different. What gives you the right to win? So, and if you want to also comment on your top line, because it's small, it's 750 crore as of last year. What's the growth runway for you?
So look, although India market is very unorganized, 86% of the market is unorganized, and you're right on that. While unorganized is becoming organized, we play in the organized sector. As India per capita, will increase over time, as we all know, with the growth in India, we will see a lot of unorganized becoming organized, and therefore, being the largest organized player, we will benefit the most. And we have taken the same playbook that we will take from India to Middle East. While we are operating in the organized market, in UAE and KSA, it's all about organized market. Yeah. And within that, the playbook will remain the same. So we will get a much better tailwind in that sense to be operating out of the large organized market with the same playbook of having a large online. And as of today, we are 100% online business in both UAE and Saudi Arabia. And as a part of use of proceeds, we'll be putting out some 12 stores in Middle East and growing our sort of an omni-channel, multi-channel story. As you take along all our India moats that we have built, we'll be exactly replicating it. We have replicated that over a period of time. So we feel very confident of our right to win, what we have been able to deliver in India.
Got it.
And in Middle East as well.
So you said the international business should turn around soon. 5 years is too long, but maybe 1, 2, 3 years down the line it should turn around. But what about the steady state EBITDA margins? Is it also in mid to high teens like it is in India over there?
Well, look, I would say, great companies will find a way to deliver those margins.
So the aspiration remains the same?
Yes.
Got it. Let's talk about global base. That's the third leg of your business, which is a house of brands where you make investments in D2C companies. Now, what's interesting is it's founded by you, it's a unicorn, but you decided to incorporate it within FirstCry. Now, the question here is, why did you do that? Because it's an unrelated business to childcare. You've got investments in home decor, you've got investments in jewelry, gym equipment kind of companies. So why did you choose to do that?
So look, essentially, it's a great question. So look, we had a great competency that we had built in FirstCry ecosystem for a very long period of time of building home brands. And we built global supply chain, global sourcing capabilities, we built tech platforms, we built brands, capabilities around digital marketing, supply chain, all of that what we built, data science, we felt we should be able to replicate in other categories which are beyond mothers, baby and kids category. And that therefore we went back to our shareholders and our board, got their blessing, incubated a company, Global Bees, in May 21. And look where we stand, building in these 4 categories of home utilities, appliances, lifestyle and BPC, HPC. Today we stand at 1,209 crores of FY24 full year revenue and adjusted EBITDA break even already in 3 years.
Okay. And what's the aspiration here?
Look, last year we grew 35% year on year.
Okay.
And the market CAGR, if you look at our industry report, is growing at a 34% CAGR for next 4 to 5 years. You can make a good guess that we should be able to do...
At least meet the industry growth rates, if not beat it.
Well,
and on the EBITDA margin, you've just broken even.
Yes,
Can it go to double digits soon, in say 2 years?
I won't be able to comment on how long it will take, but we will definitely be, improving from where we stand over next few years.
FirstCry stake in Global Bees?
50.23% on a fully diluted basis.
50.23. And the balance is held by private equity players?
Yes, some of them, yes.
So I'll tell you a risk which has come into the market is that PE players tend to churn. They have a life of their investments. So at any point of time, if a PE investor wants to exit, will FirstCry look to increase their stake? Because if they do, it's a cash outflow.
Look, FirstCry doesn't have any commitment. No commitment, no obligation. And these are very respectful names that we have taken on our Global Bees cap table, and I'm sure they will be more interested in keep compounding their wealth here with us than finding another alternative.